Welcome everyone to the 7th video in the playlist where we're building a custom algorithm for deep reinforcement learning as applied to portfolio optimization. In the previous video, we walked through the high-level algorithm that we'll be running, and we gave a little bit of a description of the underlying model earlier. And we can step back a little bit to the overall procedure we're doing here. The first thing we did was we built this algorithm, and we applied it to a toy problem, playing tennis. We could solve that. It was just really trying to set the architecture up. Next thing we did was we had some synthetic data. So we just generated some pricing history that was deterministic and time invariant. And we applied it to that one first, just again to make sure that the algorithm worked. And then of course the real deal is when we went and applied it to some real pricing information. So if I go over here, the basic procedure was the same thing we did when we went through the tennis one. So for the sake of time, I'm not going to walk through it. But basically, we built the Docker images, pushed it into ECR so we could use it. We did a sensitivity study determining which would be the best type of image to use on AWS. Then we did some hyperparameter tuning for the synthetic process. Again, these are trying to see what's the right size of layers, how many nodes per layer, what would be the learning rates that we'd have, what is the type of windows that we want to use. There are many different hyperparameters there that we exposed, and we went in and tuned those. And so what I'll pull up here now is kind of skipping over the synthetic one, just because it wasn't that interesting. We obviously were able to solve that relatively quickly and to a large extent. But again, that was expected because it was some synthetic data that was generated from the signals themselves in a deterministic and time invariant manner. So the much more interesting one is when we actually look at the real pricing. So this is just the hyperparameter tuning where we went in, we looked at all the different parameters and kind of tweaked it to try to get a process that went in and tuned it well, and this was the winner. And you can see this is the portfolio versus the market ratio for every 20 days as it was doing its training, and you could see it did a good job in training it. And this is kind of what the final portfolio looked like. This was over a year when we were doing the hyperparameter tuning, and you can see pretty consistently. A lot of times you'll see it did, like when there was an increase in the market, it just really accelerated through. It amplifies the gains, and some of them didn't do very well here, but especially lying here, it really kind of picked up. But overall, you can see over a year, the model did a pretty good job as compared to the market. So the next thing we did is it took that model, those parameters were used in the hyperparameter tuning, and we said, okay, well this time we'll let it play out for a little longer. So we let it play for the 2 years. So again, those same parameters. Right now, this is like the number of nodes on the first layer, which was 16, and we actually nulled out the second layer. We didn't need it when we had this new approach of breaking the signals per asset, which I'll go through in a second. And with that, you can see again, we scroll there, pretty consistently was greater than the market, and this is just the again, portfolio over the market ratio is one of the kind of things I look at when it's going through, making sure it was consistently built. And here's just the visual. And you can see this is kind of very similar. I've seen a lot of them. At the beginning, it kind of takes, even though we do offline training before we start, it seems to take a little while for it to really kind of get into its groove before it can start taking off. And again, when there was this nice consistent increase in the market, it really accelerated away. Although some of this is, it really kind of lost back some of the market. But overall, over a 2-year period, again, it did fairly well. Now, if you look at this, it looks pretty, pretty successful. There were some things that are still an approximation here. One, of course, is we're just picking 6 stocks, 10 stocks. So maybe, we might have been lucky in which of the 10 stocks we picked. The other thing is the losses in the trading. We did have basically a small cost of training applied. So whenever time you do a trade, you lose your portfolio value a little bit, depending on the size of your trades. However, that's probably fairly crude. Maybe there was something where we do a little more sophisticated. There may be some things that we're doing in here in this trades that you physically wouldn't be able to do in the real world, and that's certainly something you would want to really refine and make sure that any of those sort of costs and friction you have in the market is properly captured in your model. So that's the real trading. And then, of course, the really interesting thing here, so we've kind of shown that we've got a model that can learn as it goes. It constantly does a rebuilding as it goes through time, if it determines that it's not doing well, it goes into offline training, looks at historical data, gets smarter, then comes back and it continues to go. So one of the real question was, well, what would happen for the March 2020 during the COVID-19 crisis? What exactly, how would the model respond? And one of the things we actually had to do, because everything that was done before was working off of some data that was actually generated last year when we had this deep reinforcement portfolio optimization repo. And in here, there was a notebook that generated the data. So we had to go back and rerun this and get the new data. This previously only went up to the end of 2019. So we've done that, and we updated it to basically the end of June. One of the big things, it takes in some financial indicators, some fundamental stuff, so it needs to know a lot of information from the quarterly reports. So in reality, there's probably a lot of information here that's really only good to the end of March. Some of the companies, we could get the data to the second quarter reports, but not all of them had them published at this time. So with that, we pushed it in, and now there's this ability in here when you're passing in the hyperparameters to say the price's name. So you can say there was the prices from 2020 June, this new package, and with that, we let it trade. And just looking at the numbers again, this is kind of one of the things I always look at. You can see it still did a pretty good job on the 20-day. Every 20 days, it did a positive. And here you can see, again, starting up, again, this is kind of at the beginning, as I mentioned before. It kind of just stays with the market a bit until it kind of really gets going. And here you can see it started to pull away, did a pretty good job, had some good gains. And then, of course, the end of February, starting of March, things really started to fall apart. And I guess all the history we had, it was training on, probably didn't prepare it very well for this market. And you can see it lost a lot of the gains it had over the market. So here it was a pretty decent gain. But here we came down where we still stayed above where the market would be, but you can definitely see we lost back a lot of the gains. But then when the market started to recover, we started to pull away again. So by the end of the year, or end of half of the year, by the end of June, you could see we certainly have done better than the market over this period, but certainly over the cliff here. I suspect there was not a whole lot of information in the history that it was training on that really prepared it for this sort of cliff, and I think that's true for just about everyone. So with that, we've kind of shown that it can certainly respond well to the market. It didn't crash below the market or anything like that, and as soon as the market started to pick up, it really started to try to, and again, I think that's one of the things that I've noticed a lot, and you can kind of see here again, is whenever the market comes up, it kind of accelerates. It really takes advantage of that, and then it's more defensive on the fall down. So one other thing I wanted to go through is, since we have that hyperparameter tuning, we developed the model. I kind of wanted to visualize the model a bit. And if you look in here, these are all the same graphs I just shown you. Just put it in one spot so you can see them side by side. But this is the model. And so to show it to you, first what I did was I drew a simplified one. So here I just drew it with 4 different assets. We actually have 10, but I just showed it for 4. And we've got 6 signals per asset. Here's just shown with 3. And we're looking at over 10 previous days. And here's just 5. So this is the signals that come in. Then we go through that 1D CNN, or convolutional neural net here. And this expands out into, in this simple example, 9 different outputs. And the equation that determines the number of nodes that we have here is just repeated, which is the number of days in the signal. And there's a kernel. So as I mentioned before, for any CNN, and we had a kernel size of 3, so you can imagine there's a little window with size of 3 that slides across here. And that's kind of what it's looking for, the patterns on these 3 days. So the kernel size of 3, so D minus the kernel size of 3 plus 1 times the number of signals. And that's where you got 9 sitting here. Then we had this partially connected network. And what we mean by that is that this node, for instance, you can see every line here is a weight that has to be learned. And so all of these nodes are connected with these set of nodes, but none of these are connected across. So we don't cross assets. So this is kind of just in an asset submodel, if you will, trying to capture information from the asset and the signals that are associated with that asset. But then we get into a fully connected layer here, where, and this is what we want, this is the desired weights. And so the desired weight you have for a particular asset is not just determined on what the asset itself was doing, but how the other assets were doing. And so that's why there's this cross connection in this fully connected layer here. And in this is particular, this is the actor. And for an actor, it looks at the actions, as I mentioned. So these are the desired weightings. And so we have one action for every asset. So we have 4 assets coming in and 4 actions on the end. So that's the simplified approach. Here, if you look, this is, and again, it's a little bit small. Let's see if I can make it, there we go. Get it all in one screen. Here's actually what we're looking at. And now we have, again, 10 assets all the way down, 6 signals. We went looked at 10 days. That results in this little subnetwork of 48 nodes. And this has 16, and this is one of the hyperparameters that were tuned, and it's fully connected here. So you can imagine there's just, you know, an immense number of weights that have to be learned. Every line is a weight that the model is learning as it goes forward. So that's the actor. And then this is a DTPG, which is a actor-critic model. And what that is, again, the actor, it's learning and it decides what actions to take. So these are the actions. And the critic, what it does, it looks also at the signals, but also looks at what the actor decided to do. So the actions, and it develops a loss. And the idea here is that similar, you know, if you were physically playing tennis, you're the actor, you're the one that has to swing the racket, but then there will be a coach that's watching. And it's watching not only your actions, but also the environment, determine whether it was a good move or not. And so this is the loss that gets fed back in then to train the actor. So it's a bit of a feedback loop. So we actually had 4 of these. There's actually 2 during an update. But you have 2 critics and 2 actors running. So it's a fairly complex system that we're running here. And this general structure, I haven't named it, but it's the same structure as the actor. It doesn't have to be, but just to keep things simple for me, I just have this structure repeated again in here, which makes a bit of sense because this is trying to extract information from the signals. So it kind of makes sense that this would be similar. And then at the end, instead of having 10 nodes out here, 10 output nodes, we only have 1 output node, which is a loss. And then there's also this addition here of the actions. So that's the model that we end up choosing overall. And as you can see, it did fairly well. Again, this is the simplified view. It did fairly well, either over a year, 2 years, and then, you know, trading down over the cliff. So I'm quite happy with its performance. Again, there is probably some simplifications in the frictions in the marketing, so, you know, in the market trades. So we definitely would want to go back and maybe update that a bit. The signals themselves, I'm sure there's things we could do. You know, the 6 signals that we have applied here, I'm sure we could come up with something that's a lot more sophisticated than just these 6. And this network structure as well. You know, there's many different structures that you could go in and try. This one seems to be fairly successful, which I'm happy with. But with that, and again, I'll just kind of point us back that this is the 7th in this series. And if you haven't seen the 7, I'd recommend going back. And also, this series actually builds over on another one. So this is the one that was done last year. We kind of put through a system that was just using some of the standard tools within AWS, but they're very related. So again, if you haven't seen this playlist, I would recommend going back and giving some better background. But with that, that is the last of the series. Thank you all for watching, and I hope to see you soon.